So welcome to this new session of portfolio management during crisis. So I decided to change the title in the bull market number 7 because the market, as you have been experienced as well, has been extremely strong. And we're going to discuss why and what it could be in the near future. So again, good evening for those of you who are joining for the first time. Because I knew that some of you are. Just a quick presentation about me. Again, nice picture of me on the right-hand side. So I started to trade in 2000 as a cash equity trader in Paris, with an asset manager which had roughly 50 million euros. In 2004, I came to London and I worked for a hedge fund from 2004 to 2008, where when I joined the team, we had roughly 150 million and up to 600 million. And the overall company had 3 billion at the top. And from 2009 to 2018, I was a prop trader here in London for a US company, where I was trading across asset classes and across regions with an absolute return mandate. From 2014 to 2017, I was mentoring people for another company. And since 2008, I've been mentoring people under my name, and I've launched in October 2019 a 4x4 video series, which is a very comprehensive video series with a professional process. So let's jump now in what we're going to be covering today. So last week, for those of you who were with me, we covered the PMIs, we covered the oil market, we covered IG generation in FX and in from earnings season. And this is what we will try to be covering today. As usual, we will start by looking at the price action across asset classes, stocks, FX, commodities, credit. Then we'll try to see what I've been doing the retail trading world over the last couple of months, because I think this is interesting always to understand what is the retail world doing. As this is the month end, we're going to be covering the end of the months and how the sectors and the industry have been performing over these months. I would love as well to be talking about the VIX Term Structure. That is something that is extremely important for all of us as portfolio manager to understand the realized volatility and the implied volatility. Then we're going to be jumping into the world of central banks and the balance sheet and money supply, because this is all about money supply these days. We're going to be talking a bit, obviously, because we're in the middle of it, of the earnings season. Trying to keep on doing ID generation. Then I would like to end up with trading psychology, and that will be quick if we have enough time, but still, trying to cover a bit trading psychology. So let's start with, as every single week, with the price action. So as always, we are starting with the S&P. So for those of you who are joining today for the first time, what we are using here is the ES1, which is the S&P 500 future. And as you can see, the price action has been from 3,400 to 22 something, then it bounced, and now we close today at 2,900. So we had a massive rally, which started on the 23rd of March, when the Fed came with this bazooka, an unlimited QE. And since then, that has been the trend. So the trend has been very strong. We are trying to challenge it as a support. If you have been short like me, that is a bit painful first. Even if I'm not massively short. So as I discussed before, I thought that the 2740 was a good level to start a short position. So I'm still 20 to 30% net short, with now an average price of 2770, which is not great. It was very painful yesterday. But again, this is based on my process, and this is based on the exposure that I want to have, and I'm only carrying 20 to 30%. So if we look at the technical analysis here, and this is something that we mentioned before, the Fibonacci retracement, there is Fibonacci retracement 61.8% at 29.30, 29.50. We had a bit more on the Nasdaq. You know, Fibonacci, we need to be extremely careful. This is kind of a relief when it works, but most of the time, in reality, it doesn't work. So the last one, the previous one that I used was on the 50%, which was 27.86 that I mentioned, and it didn't work. But what has been happening is this month has been extremely, extremely strong. Okay, so I think it's probably the best month ever for the S&P. So the current momentum, both on the S&P and more importantly on the Nasdaq, has been very, very strong. So now on the daily chart, you can see the price action. We are above now the resistance that is now support. The trend is still here. I think both trend on the S&P and the Nasdaq are here. And if it has to be broken, then we might go into the consolidation. So that's for the equity. That is something that we're going to be covering later, but I want to be talking about the S&P 500 versus the Russell 2000. So this is the big caps versus the small caps. So as you can see at the start of March, and that's something we cover in early March, the S&P did very well, the big caps did very well versus the small caps. So there was a kind of, let's say, a flight to safety, where you go for the big ones and where you think actually the big companies will do better than the small ones. And over the last 5 sessions, there has been a massive flow driven into Russell 2000, Russell 3000, all the small and mid. So that is kind of start of a reversion to the mean. And the question is if we're going to have a follow-up. Now commodities, oil, I mean, I've massively covered oil between session 1 and session 6. So we know how it has been happening. I'm not going to do another one. There is a bit of a relief, but the reality is for the next couple of months, there's going to be a problem of supply and demand that is collapsing, and a problem of storage. Gold, because I know that many of you are watching the gold, the level is still the same, which is 1780 roughly. And as long as we're not breaking the 1780 on the upside, there is nothing happening. I think even if I'm not trading the Bitcoin, I know it's almost 9,000 now. So probably the ones that are looking at the gold are looking at Bitcoin. If we look at copper, so copper recovered a bit. I think it is still below this 247 level. So it's a rally in a downtrend. I would like as well to be, the credit market is in a much better shape since the 23rd of March. So if you look at some of the ETF that we mentioned before, it is stabilizing. Some of them are making new highs. I think this is this one, this MBS that is making new highs. And that tells you about the strength of how strong the Fed has been intervening in this market. Finally, I think what is important to be looking is at the dollar, because every single currency almost is we do care against the dollar. So there's a lot of noise as always in the FX market with the bull and the bear. So there is the case of the bull where saying, you know, it's the king dollar. Everyone is going to need some dollar, and most of the transactions are made in dollar, which is very true. But on the other hand, the Fed is printing so much money that it might be weakening the dollar. So what you can see at least is for the last months, or let's say months to 6 weeks, despite the noise, the move is between 2 to 3%. So the bottom line for me as an equity trader is to tell you that this world of FX is full of noise, and the world of equity is actually made of full of moves. Okay, so be careful on what you're looking at, because the XY currencies, you could be sitting on positions that are not doing anything for months and months, whereas there are some asset classes that are much more interesting. So let's go back to the slide, and let's go back here if I manage to do it. And I would like to discuss the retail investors during crisis, because probably 90% of the people that are joining today, are retail investors. And actually, the French regulator, which is the AMF, just released a study between February and March about the behavior of retail traders in France. And I thought it was interesting because there has been a lot of talks that retail investors, both in Europe and the US, had an impact on the equity market at least. So if we look at the French market, over 150,000 new investors bought French stocks in March 2020 versus normal 580,000 total retail clients. So that makes 27% new retail equity buyers. And obviously, why? Because each time there is a dip, each time there is some noise, people are attracted and retail traders are joining the show. What I found interesting is actually, and I kind of feel I understand now why people investing in Bitcoin, how they are looking at people investing in stocks, because here the median age of retail investors in 2018-2019 in France was 61 years and 49 years for online brokers. And it only came down to 36 years old for online brokers for the new investors. So I understand why all people in their 20s are looking at stock traders as like a very old school. But more importantly, because I'm not gonna be punishing myself, is looking at the flows of retail traders since we had the sell-off. So as you can see here, in 2019, so this is on the weekly chart, most of the retail traders were selling. Okay, and then in 2020, from the start of March, they started to buy massively the market. So there are always talks about dumb money versus smart money, and the dumb money being the retail traders and the smart money being the professionals. So if you look at the example of the French market and how people have been behaving, you can see that from the start of March to the end of March, there has been a massive amount of buy pressure. Okay, so we are talking here roughly 3 billion with a number of new clients. So I make the calculation out of this 3 billion buy, probably the level, the average buy is around 3,400. Okay, so that's where the retail traders have been buying. So if you think about dumb money versus smart money, as long as we are above the 3,400, the dumb money is not that dumb. Okay, so that means they are in the money between 4 to 6%. And why I find that interesting is because in the US, you remember probably we discussed that before, there have been a lot of new retail traders who are joining the market with options. That was the case in January and February, and this week, and the last couple of weeks. Actually, we have seen a lot of increase from retail traders in buying options. That is something that I covered many times, but here I want to give you just a quick option chain on Microsoft. So that's Microsoft yesterday, right before the numbers. So obviously, right before the numbers, you do have like a tendency for retail traders to be more active. And in that column, this is the volume on the day. So here you get the call, and here you get the put. And here, same, you get the volume. As you can see, the volume on the left-hand side, which is the call, versus the volume on the right-hand side, is roughly, I calculated, you get 230,000 calls versus 94,000 put. So that gives you a put-call ratio of 0.4, which is roughly the same put-call ratio of 0.4 that you have for the equity market, which is a very low level. And if you make the calculation in terms of delta, you end up with 1.3 billion on the left-hand side and 300 million negative. So you get a delta positive of 1 billion. So to make it simple for those who don't understand what is, delta, what are options, it's if you are in the US market, you don't have much leverage. So if you want to have a good exposure to the equity market, the best way to do it versus in Europe where you can have 4 times leverage is to be using options. So imagine that you do have $500 in your account, you will be buying 2 options here, 2 calls of Microsoft for $220, which is times 2, 440, and you'll have exposure to Microsoft. So this is what the retail world have been doing recently, and this retail world, these retail traders have been doing those positioning across names that are very hot. So we are talking Tesla, we are talking Amazon, we are talking Microsoft, we are talking all the names, these 50 names that are making the headlines. But that is massively distorting the price action across those names and across the sectors. So again, I think the conclusion for this is over the last couple of months, we have seen a lot of new money from retail traders. At the moment, what is called the dumb money, and I don't like to say this is dumb money because, I think this is pointless, but retail traders are in the money between 3 to 5%, probably something. But we know as well that retail traders could be shaky very quickly. So 3 to 5%, you don't need much for them to be negative, and then for this positioning to unwind. Okay, so that was the first part. Now what I would like to do is looking at the second part, as this is the 30th of April, looking at what has been happening along this month. So that was a few hours ago, so a couple of hours ago. But what I like to do during the 4x4 video series, during the mentoring program over and over, is to understand the price action and what has been moving on the months, on the 5 days, on the 3 months, on the year to date, on the 5 years. So you're going to have the picture long-term, mid-term, and short-term. So here, if we take the short-term, which is 5 days and 1 month, I'm interested to know what has been moving on that month. So as you can see, the first one is energy. So if I look at energy, I know that the sector was completely hammered in March. So it's a kind of recovery for bad names, but by no means that tells me about the strengths of the market. Then I have the consumer discretionary, and I use 2 consumer discretionary because I'm pretty sure some of you will say why there is XLY and RXI, because XLY is a bit distorted, is more than a bit distorted, because it's 20% plus in Amazon, whereas RXI is only 10%. So you have a big chunk of Amazon here, which is, again, making the numbers pretty high. But the bottom line here is, if you go to the names, you can see that this is a risk-on rally, whereas then, all the boring names and risk-off and bonds and yields and utilities, whatever, have been underperforming. So you don't need to be a genius to know that we had a massive rally on risk-on, but I always find it interesting to cut my time frame into different time to know what has been moving. And as I said before, what has been extremely interesting over the last 5 days is the outperformance of the small and micro cap, which you find here, the 5 days, which moved like 8-9% versus the big caps around 3%. So we had a massive reversion to the mean. Again, we discussed that before. Investors went for big caps, always the same names, 20% of the 5 names in the S&P were outperforming. And if you look at the chart of the S&P versus the Russell 2000, that gives you this chart that we looked at before. So from March onwards, we had massive rally. So you go from 2 to 240. So you have a 20% outperformance of the S&P in let's say 15 days. Then you have the consolidation, and since then, over the last 3 to 4 sessions, we had a 7-8% outperformance from the Russell 2000 small and mid. So the question now is this small and cap an indication that we're going to do better? If you think about the meaning of it, is there is a flight to safety when you go for the big caps, and at the same time, small and mid caps have, by definition, a higher exposure to the US. Okay, so when you go for big caps versus small caps, and is you think because the rest of the world is going to do better versus the US. Okay, so that was the case. People were scared from March onwards that literally the US was plummeting. Now, there is, through the help of the Fed and through the help of the possibility of reopening the economies, those small and mid have been doing better, but this is not still a strong trend. So we have to see in the next few sessions and few weeks what is going to be the trend. Next one, I would like to discuss the VIX term structure. So for those of you who have been doing these other webinars, this is very similar in that sense to the oil structure. So what you have for the volatility with the VIX is you have several future contracts, okay? And as you can see here, you get the May, the June, the July, December, and other ones. As you can see here, the price of the closest contract is still above the contracts in the future. So we are expecting volatility to come down in the future. Normally, the structure will be the other way around. So in a normal market, you'll see something like this. So you'll see the volatility in the future that will be higher than now. In terms of points, and that was yesterday again, so that has changed since then, with the 29.41 close on the S&P. When you have a 32% implied volatility, that means over one day you should have a 58 points move on the S&P. And guess what? How many points did we have today? Probably we had 60 points roughly on the S&P. So here you are banging your money in terms of implied volatility. Over 1 week is 127 and 264. But actually, these 58 points implied volatility, for the first time in probably a couple of weeks, has met the expectation. So this is something that we discussed from beginning of April. There has been a dampening of implied volatility and realized volatility. Okay, so realized volatility every week we saw the realized volatility coming down. So that means there was less and less moves of in the equity market. So what I find interesting here is the VIX term structure. So if you look on the blue line, that is the VIX term structure a month ago at the end of March. And in orange, this is the VIX term structure today. Okay, as you can see, the first part, the closest part of the VIX is coming down. So all of the VIX came down, but the other part is still the same. So what the Fed has managed to do, and is coming to the market and dampening the first 90 days of the VIX structure. And what we discussed as well is the struggle for us investors. Even if you were seeing any downside, the cost of the volatility was too high. So as a portfolio manager, as a trader, you need always to think, okay, what is my risk reward of protecting myself through options versus the future? Yes, when you have implied volatility, which was at 46%, yes, you can go to 90%. You can go to 80% again. But the odds in general are pretty high for this to go lower. And in terms of risk reward, that was not a good risk reward. So to give you an example, when I look at the market at 27.30, 27.60, 70 as a short, I went through the futures. I went to the ETF because the risk reward to the option was way too expensive. Maybe now it is the time because everything is almost flattish. What the Fed would love to have is, instead of having 30, is to go there to the 20s level. To do so, it's possible they will have to dump in even more money. But at the moment, we are at 30%. But except today, which felt like a bit like a 30%, it feels to me, and when I ask to my ex-colleagues, it feels to me that this is a market that should be trading with a VIX between 16 and 22%. It feels like the implied volatility is too high at this level. If you look at the internal price action, it is not a 32% implied volatility. Okay, so let's look into one of the best charts ever, that it's always the same when we do these sessions, is looking at the central bank's balance sheet. So on the left-hand side, we get the Fed balance sheet, which is now at 6.5 trillion. I think they're going to be updating the numbers today. And on the right-hand side, we get the ECB, which is at 5 billion euro more. Interestingly, this week, we had many news from the central banks. That started on Monday with the Bank of Japan. Last week, we discussed the possibility of them doing unlimited QE. That was confirmed. So they're going to go kamikaze all the way to the wave. Then yesterday, we get the Fed, which is going to be doing more if needed, and the ECB that actually today did some to help the banks, but not that much in terms of QE. So if you are an American capitalist and you're looking at the socialist European, that might be the other way around these days. Actually, the US are doing more than the socialist Europeans. But today we had another announcement from the Fed. So that's something that is started last month, and that's from the big announcement that they make on Thursday 3 weeks ago, which is about the Main Street Lending Program. And the Main Street Lending Program is about helping, as the name is saying, Main Street. So for those of you who are joining for the first time, as I said before, that is extremely helpful to put your name on the mailing list of the Fed and the New York Fed and any Kansas City Fed and all the Fed that have a mailing list with some research and some update, because these days they are big as market maker. So the question is not to be saying, I want the Fed or the ECB or the BOJ to be doing this and this. It's just to play with what they are doing. And at the moment, they are owning. But what they are telling us is they could be doing more. So what I find interesting from this Main Street Lending Program is they are okay to lend to those companies at LIBOR plus 300%. So if you are in your 20s, if you live in the US, if you get $200,000 plus debt students, and you are paying 6, 7, 8%, I can understand that you are very upset, because 50% of the US company could be helped with a loan that is half yours. That is for you to see if it's right or wrong. But that tells you about how much central banks are doing these days to help the economy. So that what I would like to cover on top of the balance sheet is the money supply. Okay, so the money supply, this is something that I cover in the 4x4 video series. So the money supply is the total stock of money circulating in the economy. So when I was doing the 4x4 video series, I did some research, and you're always looking at the correlation, obviously, between money supply, the economy, the velocity of money, inflation. And I came out with this good summary from the Federal Reserve Bank of San Francisco that stated in February 2005 that the faster the money supply growth should be associated with faster economic growth after a short lag of perhaps 2 or 3 quarters. So here you get 2 or 3 quarters to kick in the economy. However, many important changes in how financial assets are held by the public have changed over time, and the relationship between money supply growth rate and the economy has deteriorated. And here, this is extremely important. The correlation between money supply and how it is helping the economy has been weakening. So quickly, I put the different types of money from M0 to M3. So I don't want to bother you, and that will be on YouTube soon, so you can go through it again. So you have the M0, which is the sum of currency in circulation, M1, currency in circulation plus the current checking accounts, M2 and M3. So M1 is a good reflection of monetary policy, meaning that when the Fed wants to tighten, they will slow the supply growth and vice versa. And when the Fed is raising short-term rates with a tightening of its balance sheet, there is less money supply coming into the system. So why I want to be talking about money supply is because recently money supply went through the roof. So if you look at the top chart, which is M2 money stock in billions of dollars on a weekly basis in the US, you can see this spike here, but that is more telling in this chart, which is on a weekly 4 weeks average. And here, this is on the weekly change annualized. So the Fed has been putting a shitload of money into the system through M2, okay? And what the central banks do is they use M2 massively, or money supply, when there is obviously massive pressure in the system. And as you can see, that was the case in 2008, 2009, and that was the case in 2010, 2011. So when there is a stress in the system, you use the balance sheet and you use money supply. But you can see the size of the stress versus 2008. That is just twice the size. So to put it in other words, if you look at the velocity of M2, so just want for you, all those data, you can find this on the St. Louis website. So, and here I'm going to give you the Fred definition of money velocity, which is the frequency at which 1 unit of currency is used to purchase domestically, produce goods and services within a given time period. In other words, it is the number of times $1 is spent to buy goods and services per unit of time. As you can see, the trend is not my friend. So that means what? That means we have seen low inflation in our current economies for the last 20 years. And to make $1 moving in the system, you need more and more. So the diminishing returns of Fed balance sheet, the diminishing return of M2, M3, whatever, is really coming down. There have been some talks recently, and this is why we discussed the goal before, that as central banks across the world are putting that much money into the system, that could lead into future inflation. At the moment, obviously this is too early, there is no inflation, but that is still something to be monitoring. But I think as well that tells you that what the central banks have been doing is just unearthed. That tells you why you see massive rallies across equities. That tells you as well, if the Fed is doing much more than any central banks and putting that much dollar into the system, that might be weakening the dollar. So on one hand, you get the idea of moving to the best currency, which is the dollar, because king dollar. But on the other hand, if you keep on putting shitloads of dollar through the balance sheet, through money circulation, that is weakening the dollar. Okay, so I'm not smart enough to tell you which way it's going to go, But what you need to be doing is monitoring this level of money velocity, of money supply and inflation. So again, over the last 8 weeks, and that's the case across, so there was the European numbers yesterday, the money supply has been jumping through the roof. Okay, so that means, that tells you even more the stress that economies have been and our markets have been experiencing. So next one, earnings season. So last week we discussed the earnings season. We discussed the earnings season with the software, which actually have been going 3% in my face. So it's not it's not really working, but 3% I can still handle that. So this week we had many earnings. I find interesting always to read or to be listening to the conference call. I read Google, I read GE, I had a look at McDonald's, I had a look at Boeing, and today after the close we had Apple and we had Amazon. I think Amazon is down and Apple is up. But the bottom line is this: is for the newcomers. There are two websites that I find useful. Benzinga, Earnings Whispers. Why? Because when you put a position or when you want to put an idea into your watch list, you always want to know when is the company next talking to the market. And that is even more true for knowing what's the leader in a sector, what's the leader in one sector, one industry, one region is going to do. So today, Apple, Amazon, there's going to be many more next week. But instead of doing a single name, I would like to talk about, how the earnings season has been so far. So I'm always interested to look as well at names that can be moving the market and names that are a good indication of the economy. So this week I look at General Electric. So I know General Electric is really a dog. It's really a company that has many issues and because of its balance sheet not generating enough free cash flow. But this is a good, let's say, indicator of the overall US economy. And if you look at the price action of General Electric, it is for me very similar to the WTI by saying something is wrong in the real economy. So you have to find the tools, you have to find the drivers that you like to do your understanding. But GE for me is one of them. Again, I say that it's like IBM. I know those are companies that have been, losing market share, struggling for the last 20 years. But at the same time, that tells me a lot about the US economy. So looking at the earnings season, I like FactSet. So they have a mailing list. So if you want to, you should subscribe to this mailing list because they tell you about how the earnings season, any earnings season will be doing. So this is a bit old because this is from last Friday. And that's the S&P earnings growth for Q1, which is this one, by sector. So what I found always interesting, and this is something that I cover in January when I look at when I cover the Outlook 2020, for any single year, analysts, market participants will start the year being very bullish the energy sector. And this year, obviously, it's not helping with the coronavirus, but as any single year, they're going to be missing the numbers like there is no tomorrow. Okay, so if you see here the today, which is in dark blue versus the expectation a month ago, that is a huge delta. And that's the same across sectors. So all the sectors have been downgraded massively over the last 4 weeks, which makes absolute sense. But as you can see, some sectors are doing worse than others. And those are the sectors that are really giving you the picture about the cycle, the economic cycle, and how the US consumer is doing. Here you get consumer discretionary. Everything that is defensive, utilities, here, consumer staples, healthcare, real estate. I think real estate is a false defensive one. So here you need to be careful. But you have the defensive name that have been doing okay. and all the real economy, maybe it's a big word, but the cyclical stories have been suffering big time. That is on an earnings growth, and that is on the revenue growth. So same story, revenue growth, industrial suffering big time, energy, materials, consumer, so all the cyclical, and the defensive have been doing a bit better. But what I find interesting when you look at earnings and is to get the big picture. And again, this is something that I did with the Outlook 2020, is always trying to understand what you're paying when you're paying the equity market. So here we have the earnings by year, and that's the operating earnings of the S&P 500 from 2016 to the expectation of 2021. So for 2019, here, the operating earnings for the S&P were 157. Okay, so the growth on the year was 3.6%, whereas the previous 2 years we had roughly 20%, which is mostly explained by Trump cutting taxes and not because the economy was on fire. But what do we have now for 2020 expectation? And that was from last Friday, from the consensus. So the consensus now is staying at 136. So if you take 136 and you take the S&P at 2950, you are paying at the moment 21.7 times earnings. And if you take 170 or 171 earnings for the S&P right now, you are paying 17.3. So many questions here. First thing is, on average, the PE of the S&P has been 14 times. What you have, because of low yield, because of cheap financing, this 14 is going into the high 10s. And now people are saying, it could go into 25 times. I mean, then there is no limit, but you need to know where you are versus the long-term picture and what you are paying at the moment. Plus, I think what is key is if you have 136 and you expect 170 next year. So that means from 2019 for next year until next year, earnings are going to be up roughly 9%. So here you make a decision if that makes sense to you or not, and you can start to be building your exposure based on that in terms of valuation. This is not a perfect, I don't like PE normally, okay? So what I like is using what are the earnings growth expectation, and how much I'm paying, okay? And more importantly, here you can see the expectations. So 171 for next year, where we know that most of the time analysts will be extremely bullish or overly bullish at the start of the year. So that is looking at the earnings on the big picture, plus on a yearly picture. If you think about quarter on quarter, Q1 of this year in the US was only 1/3 impacted by the coronavirus, okay, because it closed most of the economies from March onwards, and that was even more true in the US. So that means Q2, where we have almost all economies that are closed, is going to be a complete disaster. So be careful here, because you are always paying, as an investor, what's going to happen in the next 6 months. So we know that, Q1, Q2 is Armageddon. It's just the end of the world. Still, if you look at the expectations, and if you look at what are the expectations? 171, which makes 17 times. And what you are paying at the moment, you are paying 22 times earnings for this year. Okay. Finally, I would like to finish with trading psychology. So I was lucky just before I went into this call, there was the Financial Times front page for tomorrow. And I was interested in looking at this one, which is, US market had its best months in whatever years. And I know that because yesterday I had a bad day. But more importantly, I had many people, mentees, ex-mentees, possibly new mentees, come to me and say, look, Greg, I don't know what to do. It's going against me. So the first thing first is, if you have a good risk management, and you are exposed 20 to 30%, you know, it's painful, but you're still alive. Okay, so it is just a bad day. But what people, in terms of trading psychology, is, and I think they clearly say it, you know, fear of missing out, the FOMO, the Fed liquidity supports drives rally. And this is why I started the call with retail traders, is you need to be extremely careful of the noise that, you know, you can have on Twitter, the noise that you can have from educators, the noise that you can have for other traders. I give you another example. Someone contacted me and said, you know, this person made X%. And I know this person, and I can tell you this person never made this X%. So what is hard is to stay focused on what you're doing, and at the same time, you know, taking into account into what is happening, but you don't want to be disturbed by all the noise. And I give you another example. From 2009 to 2018, I was working for this prop firm in London. And every single day, at the end of the close, we had the P&L by email of all the traders. So every day you could see who was making what. So obviously, when you're a manager of this trading room, the idea is to motivate people to say, look, we want people to be making more than this guy or this guy. So you're pushing people to be the best as possible. The thing is, in the long run, that is extremely hard because, you know, if you're making 10 and someone is making 30, you think I'm a piece of shit. If you're losing 20 and most of the team is losing 50, you think I'm losing. So the bottom line is trading psychology. And I know it is hard. It's hard in the long run. I know it's even harder these days with superheroes that are telling you that are making 50%. The ones that are were telling you to close the book 15% below are now telling you that they made shitloads of money. And this is always the same story. So, and I know because it affected me when I was a professional, it still affects me. And we need to find ways to protect ourselves, okay? Because in the long run, what you're gonna do is, if you have a process, you generate ID, but you don't have any signals to buy and to sell. So that means you're rightly following the process, which is telling you this is not the right time to do it. If the market is moving like it is these days, up 2%, down 2%, when you have stocks moving 15%, every day you could tell yourself, oh, I should have been making 15%, oh, I shouldn't be. And then you're going to be forcing the trade. You're going to be fear of missing out. And then this fear of missing out, you're not going to be respecting your strategy and your process. So this is something that I tried to cover during the 4x4 video series. For those of you who are joining, the 4x4 video series is something that I built in last year, that launched in October 2019, which is a very comprehensive video course to get similar professional investment process. So it is built around macro analysis, where I want you to have your own infrastructure. And here, this is very important because I know that many people are struggling. I want to generate IDs, and the way to generate IDs is the same as what I was doing when I was working for a hedge fund as a prop trader. You use macro, you use bottom up, you use special situation and active trading. Then what you need to be doing is both quantitative and strong fundamental analysis. That will lead, hopefully, if you're doing the first part in the right way, you're going to be building a watch list with price action technical analysis, and you're going to overlay all of this with a good risk management. What I do is, I've been trading across asset classes, and I use options as well to do both direction and to do your hedging. So you're going to have 40 plus videos, 50 plus Excel spreadsheet. To give you an example today from the 4x4, I use the video 10 bonus on money supply, the video 9 on central banks, the video 5, video plus 5 bonus, and the video 26 on options. So if you want to see what is the feedback that I had recently, you can go on testimonials. And for more information, you can go on the website at gregoiredupont.com/education. So what about almost 1 hour? We go into the Q&A session. Why did you leave the ITPM? I already answered this question last week, but if you want to know more, we can have a chat. Why do we look at futures? Why not the S&P 500? I look at the futures because it's trading 24/7, not 24/7. It's trading, you know, almost 24 and 5 days of the week until Friday 10 UK time. So it's trading most of the time. It is very liquid. So it's trading overnight. When the cash it's closed, it's trading on the Globex, so I can have a position overnight, and that tells me a lot about the positioning. So yes, I hope I answered the ES1. You can be using SPX, okay, for technical analysis. You know, you can be using SPX. You can be using SPY. I like to be using ES because I have a good feel of what's the price action and on an hourly basis, even overnight. And I know that most institutionals will be using this. Let's go here. Amazon missed earnings, stock down after hours. I think the expectations were high. Should we only be deploying long-short portfolio when VIX is below 20? I think this is something that I discussed last week already. If it's below 20, I mean, I know what you've done, and I know which education you work with before. If you have been using this education, you have not been doing much for the last couple of months, okay? Below 20, obviously, you have more facilities to be building a portfolio, but it's all about gross exposure, net exposure, and leverage. So before doing the below 20, you should do these 4 videos about risk management, and then you're going to be able to discuss about how to build your portfolio. Where do I find this VIX term structure myself? You need to build it. You need to do it. If you go on the website like investing.com, okay, and you go on the VIX and you go and you look at the different contracts, or if you go on what's the CBOE.com, they're gonna have the different future contracts, and you're gonna be able to look at the VIX term structure. I think there is another website. If you send me an email to contact at Gregoire Dupont, I will give it to you. I can't remember the name right now. What else do we have? When generating trade IDs, most companies are all getting rid of guidance, so it is harder to trade now. Yes, all of them withdrew their guidance. That is very true, and I think this is why it is helpful. Normally, you know, sometimes you can skip sometimes, you know, the earnings call. Now I think it is impossible to skip the earnings call. If you have a position, if you want to have a position, you want to know what the company is telling. So if you look at Facebook, they told you that, you know, they benefited and they've done okay. So all the advertising across the world has been cut except from Google and Facebook. But what Facebook is telling you, if there is another wave or slowdown, they're going to be impacted again. Okay, so that is one for Facebook. I looked at what was the other one. I think it was Microsoft. There was things as well that were interesting. You need to go down into those names and be listening to the earnings call. How did you perform this month in terms of percentage? So this month I'm up 1.5%. So just to give you the number. So what I'm trying to teach people is to be making 15% every year consistently. Okay, so I know that people are going to tell you 20, 50, whatever. Is to be making 15%. If you can build from there, that is really good. Why? Because the best portfolio manager of this world are making 15, 20%. So if you can start from scratch and be making 15, that is great. So if you look at, I go back into trading from the end of January this year, beginning of February. So until now, I'm up 7%. Why? Because, you know, 7% I think is a good start. I could be doing better, I could be doing worse. But what I want to be doing with this portfolio is to tell people, okay, this is the way you should be doing things. So when I do these sessions every week, some of the ideas, and probably more than 50% of the ideas that I'm talking about, will be ending in my portfolio. Okay. I saw you use Trello. Is it good? Yes. Yeah, it's good. Yeah, it's really good. It's, if you have a project, that is good. So I want to be the best. Thank you. ITPM was up 85% last year. Okay. Okay, I'm not interested in that. Hi, Gregoire, can you elaborate why real estate sector is a false defensive? Why is it a false defensive? So if you think about real estate, what you're going to be getting is some yields. Okay, so you want to have, you know, these 2 to 5, 6% yields. But what you are holding when you are holding real estate, you are holding by definition real estate, but with very few equity and a lot of debt. Meaning that when you get a credit bubble, when you get a credit stress, it's going to be one of the first sectors to be impacted. So the only way real estate, commercial real estate, is doing kind of fine these days is because the Fed jumped in massively and bought a ton of mortgage-backed security. Otherwise, the whole sector will be down 50%. But if you're putting 10, 20% of equity versus 80% bond or credit, if the prices of real estate are down by 10%, equities are gone. Okay. So the first reaction is you think this is defensive, but if you think about real estate, as you are using the leverage, it works until people cannot pay back their mortgages. And here, if we think about commercial real estate, if you have 50% plus of the businesses, of the retail businesses, shops that are closed, that means you don't have any income. That might work for a couple of months, but if it's more than a couple of months, then you can't pay back your mortgage anymore. Kevin, are the current earnings for Q1 a true reflection of the health of the company going forward? I think for the health of the company, if you do have like some doubt, you need to check if the balance sheet is strong enough for them to survive. Okay, so if they can survive another couple of shit months, then it's fine. If they don't, then you get an issue. If you look at Chesapeake yesterday, which is going under, which is going under. If you look at most oil services companies, they don't have enough cash to survive the next couple of months or more. So we know that this is Armageddon everywhere. So to get the picture, clearly we get visibility for a week, okay? But you want to invest in businesses where you think that they're going to be surviving at least. And then you start to make a decision. When you have a portfolio, you need as well to have these trades where you think that the risk reward is extremely, extremely good. Where if you think about a scenario like this one, there are some industries that are down, 80%. Maybe the trade is to be picking one of them, one name, where you put 2-3% of your portfolio, but it's not to be making, 20-30%. It's to be making 100% out of it, or 200%. Okay, so this 2% is going to be making, 7, 8, 10%. The problem here is, if you ask me about all those industries that have been murdered, they have been murdered for a good reason, is because the demand is completely gone. And I'm not sure that the demand, unless we get a vaccine, is going to come back quickly. Sharpe Ratio, I love, because everyone is asking me, there are people that are always fascinated by the Sharpe Ratio. Okay. And when I used to be working for this prop trading shop, I used to have the best Sharpe Ratio of the training room. Okay. And they came to me and said, look, Greg, you get an amazing Sharpe Ratio. And And so you feel like, you know, Sharpe, and I never really look into my Sharpe ratio. I never really bother. The reality is, people in the industry can tell you very quickly how you do the risk management. Okay. If you have a good risk management, they will hire you. And it doesn't matter what size you're talking. And this is why each time I see someone telling me, you know, I got a book of 50, 100, 500, 1 billion, I don't care, because that really doesn't matter. So size, size doesn't matter. What really matters is your risk management. Between you, on the web, 4x4 has only 33 videos shown. Where is the rest of the 40 videos? So the 33 videos are without the bonus videos. So there are 7 bonus videos. So that makes 40 plus. With those 40 plus videos, you're gonna have 50 Excel spreadsheet. So 40 videos that roughly give you 30 hours of footage. Can I hedge using inverse leverage ETF? Why you're not taking, you know, being short the ETF and that's it? I don't like leverage ETF. By definition, you know, you can do ETF, but why doing leverage ETF? Don't go for them, because if there is sometime, you know, dislocation, those ones are really struggling. Yes, let's have a chat tomorrow. That will be great. Isn't ID generation better than risk management? Because if the IDs are rubbish, then you'll be putting out fires. Okay, I see where you're coming from as well. But let's put it the other way around. I have tons of people who believe that they have a good ID generation because they think that they bought a nice process. And they made money for 2 weeks, 2 months. Then they lose 70, 80%. And they came to me and said, look, Greg, I should have done the 4x4 video series long time ago, because I would have been saving the money. Okay. So if you don't have risk management and you go have good ID generation, when something is going against you, you have no idea what to do and you don't cut. Okay. If you start with the good risk management, then you can build your ID generation. And the thing with ID generation, you are always learning for ID generation. It's always a learning process. Whereas risk management, you know, those are basics that you apply. Yes, obviously there are the ways of structuring trades, but to think that, you know, over 6 months, you're going to be dealing well with ID generation, it is nonsense. Okay, you can have the basics, you're going to have some processes, you're going to have different ways of doing the processes, but, you know, if you don't do that hand in hand with risk management, there is absolutely no way. And that we can, I'm not even open for conversation with people that are saying that, because it's just people that come to me saying this are all the people that are down 20% years after years. And I've seen so many people that telling me, oh, 5 years ago, I used to do this and I make 50%, then I'm down 70%. Whereas the boring guy who is boring guy has been making 10% for the last 10 years every year. And this boring guy compounded is making, you know, 5 times more than the guy that is obviously losing. What else? Let's go for the last one. Then I think that is the one. No, I'm not saying that the industry is not looking at the Sharpe ratio. The industry is looking at Sharpe ratio, definitely. So the industry is looking at Sharpe ratio to above. So they will be definitely looking at your Sharpe ratio. But I think, you know, beneath the Sharpe ratio, you need to understand how people are making money. And this is what is important for hedge fund. This is important for prop trading. But, you know, if I have many people that come to me as well and say, oh, my Sharpe ratio is X and the Sharpe ratio is over a couple of months, and they don't have a process, you know, you should first thinking about, you know, how to build your process, how to deal with your process, and then your Sharpe ratio will naturally be coming. Don't think the other way around. Don't be don't be, let's say, hammered every single day by your Sharpe ratio. Show us some journal recording practice. Yes, I should. But look, if for some journal recording practice, the 4x4 is really helpful. Okay, I think we're done for today. Last one, then I go. Or you mentally avoid competition with other people in terms of performance and P&L. Look, my friend, this is a very valid question. Okay, this is a question that is really, really hard to. It is something really hard to deal with. I'm going to give you several. I gave you already the example of every day the P&L. Okay, so you are in a trading room every day. You know that X and Y are making X or that, and at the end of the year, you know who has been making money. That's a good way to push you to make more. But in the long run, when you're always in a competitive situation, that is hard. That is really hard. So how to do it is you need to have your process in place. You need to look at how you're making money, how you can outperform. And I think having a journal and putting your trades, trying to I went through several traders, either experience or retail, and they asked me, okay, this is my trades. Greg, try to find me what is wrong or what is working with me. And very often, people have exposure to sectors, to industries where they don't have any idea that actually they are losing the money. So you'll have people that will be very, very good with boring stories. Let's say, going for industrial, going long, short auto stocks, they'll be making 10, 15% every year. And they could be down because they go for sectors where they can't do the risk management or they don't have the stamina to go with it. So I know some of you are fascinated by people from the industry, from people in Twitter that are telling you that they make X millions, that they are making X%, that they are superiors of this. Well, I think this is complete bullshit. At the end of the day, there will always be someone that is better, who is better than you. Okay, but you will realize that the guys that are really good, if you think about Simons, if you take of some of the guys that are really good, they don't show up their muscles and telling you that you're a piece of shit. Okay, and I think if you like to go for those people, then in the long run, that's going to be too hard. You need to build your process. You need to be helped by some people that are going to challenge you and help you. I give you an example. When I went into for prop trading for this US company, I joined the company. And there was this, and now he's a friend. There was this French trader, and he was the king. He was trading like, he was the king. And I was sitting next to him, and most of the day, I was like, I can't trade because it was too much. So I asked the management to move some seats because I was unable to trade. And when I was trading in Paris, I was sitting next to another trader, and this trader asked the management to move to another place because I was on fire and I was making money. But look, I was on fire, but probably versus another guy, I was not making much. So you need to look at the numbers. The beauty of this job of having a portfolio, PA or professionally, is the numbers don't lie. Okay, so if you're targeting 5 to 15%, you're up 7% after 3 months. Yes, you're gonna have guys that can be up 50%. But I can tell you that the guys that told you in January that they were running a 1 million book, that they will put their book on internet, and 3 months later, there is absolutely nothing on internet, or the people that told you 2 years ago that, all their teams were making 80%, 500%, but actually there is nowhere a number, it is bullshit. Okay, so I think what I'm trying to say in terms of psychology is I know people these days are very affected. When there is volatility, it is very affecting, and it's affecting to any of us because the fear of missing out on the way up and the way down. And if you do so, it's because you don't have any risk management. So to come back on the risk management with ID generation, I know what people are selling in the industry of retail trading in terms of, the upside and people are always successful. And I think what is very en vogue these days is to be selling options, okay? Because you want people to believe that the upside is unlimited. Yes, but if you don't understand how options are working, if you don't understand that you pay premium, that there is time decay, theta, that implied volatility could go lower in your face, that can be extremely costly. Okay, thank you very much, all of you, for joining today. I hope it helped. All the information, you can find it online. I will put the video online in the next couple of days. If you have questions, send me an email to contact@Gregoire Dupont. If you have questions of, how to help you on psychology, even if you have interest in the mentoring program or the 4x4 video series, please send me an email, and we can have even a Skype call to answer some of the questions. I hope it helps. What is the email again? So it's contact@gregoiredupont.com. So you can go on the website. If you go on the website, there is a contact page where you can send me an email, and I try to come back to you in the next 1 to 2 days. Good talking to you. Be safe. Tomorrow is a new month, new position. Earnings season is still on. Central banks are big, so be careful, and be good with your risk management, because risk management is very important these days. Thank you again. Bye-bye.